The international indirect tax comparison was carried out using data from 22 countries around the globe. An analysis of the taxation on the range of consumer goods and business items ranks Ireland sixth most taxed country out of the 22. Alan Farley from accountancy firm UHY believes that the situation is even more stark if you look at individual sectors.
Sadly, Ireland is probably the sixth worst country in our survey of 21 countries. So it shows Ireland in a very bad light. And that doesn't tell the full story, because when you look at the likes of petrol, we are nearly the highest taxed in all economies. And when you look at somewhere like Holland, where the tax is 10% less than us, it really makes a huge difference to the consumer when buying petrol and diesel at the petrol station.
The survey examined a broad range of items from daily consumables like bread and newspapers, clothing, electronics, and included transport items and business services.
Our shopping basket was quite extensive, and we looked at fuel, we looked at energy prices, we looked at clothing, we looked at electronics, we looked at a food basket, and we've been seen to be very expensive in areas where fuel and energy are concerned. And I think the government have an opportunity to move on that at the present time.
Alan Farley believes the findings should provide a guide for government when shaping their fiscal policy. He says past experience shows that cutting taxes on items can often deliver a higher revenue yield.
What we've seen in the past is when the government cut indirect taxes, like cutting VAT from 13.5% to 9% in the service industry, that had a huge effect on the hospitality sector. And the trade did come back, and the people were able to avail of the discounted rates and get back in there and start doing business again. And by putting up VAT from 21% to 23% last year, the government have stymied spending.